Good morning, everyone, and welcome to the Delaware Association of Realtors Tax Seminar for Realtors. We're glad you could join us for this informative session designed to help you stay ahead of tax season and make confident financial decisions for your business. I am Matt Lafferty, Chief Operating Officer for the Delaware Association of Realtors. Before we begin, a few housekeeping notes. All participants are muted during the presentation to ensure clear audio for everyone. We ask that you please have your camera on during the duration of the presentation. If you have questions, please type them in the chat box. They'll go directly to the host, and we'll address them throughout the presentation. And finally, please note that this session is being recorded and will be viewed later. Today, we're honored to be joined by Tammy Ordway, CPA and partner with Faw Casson. Tammy is a highly respected accounting professional with deep expertise in taxation, business consulting, and financial planning for independent professionals and entrepreneurs. Her experience working with realtors and small business owners makes her the perfect guide for today's discussion. Please join me in welcoming Tammy as she leads us through today's session.
Thank you, Matt. So I'm pleased to be here again this year. I've done this several years in a row, and our format is a slide presentation, but I also really encourage questions throughout. So if you want to go ahead and put them in the chat box, and then we'll be monitoring it throughout now and answering your questions. We're meant to be about an hour, so maybe towards the end, I'll follow up and see if there's any questions too. And I'm going to talk about a lot of things that have to do with being a realtor and being in business. This could also apply to brokers. So this is meant to be valuable for several people in the industry. And then I'm also going to go over some highlights of the One Big Beautiful Bill. So again, I thank you for the opportunity to do this again from the Delaware Association of Realtors. And we'll dive into it right now. All right, so that's me, 35 plus years in accounting. So I started right away. I'm born and raised in Delaware. I really like the small business atmosphere in and around Kent County and our state. Our state is very accessible. Being in Kent County, you can easily do business with people in Newcastle or Sussex. And I'm the director of entrepreneurial services at Faw Casson. And really, what entrepreneurial services does is it believes that the foundation to your business success is record organization. If your records are organized, then you can make management decisions. You can also get your return done more efficiently. Your financials are a management tool for you because a lot of times business owners are great at doing what they do, but having accurate financials is kind of what falls to the wayside. So hopefully I'm giving you some information today that will help with that. All right, let's first talk about a new business startup action plan. I get asked a lot, should it be a sole proprietor? Should it be an LLC? Is a corporation necessary? What is the difference in taxes? So I'm going to go over this at a very high level. If you are in business and you get a business license, it is encouraged that you even get a federal EIN, employer identification number, so that you're not giving your Social Security number out to have on 1099s and whatnot. So you're a sole proprietorship. And the way you're taxed as a sole proprietor is you take your income minus your expenses and you pay your taxes on the net income. You pay self-employment. Self-employment is Social Security and Medicare. And currently right now, if you're self-employed, you pay both the employer and the employee share because you're self-employed. So that rate is 15.3%. So if you're paying 15.3% Social Security and Medicare, and you're paying, let's say, maybe close to a 20% federal rate, now you're up to 35%. And if you're at the max state rate, you could be somewhere around 6%. You could have 41% of your income subject to tax. And so later, I'm going to go through important record keeping ideas to help mitigate that as much as possible, help reduce it. There's a lot of things available to business owners, but you do have to keep proper books and records. Now, some will say, well, I'm going to become an LLC. Is my tax structure different? No, that's because the IRS does not recognize LLCs as a separate tax-paying entity or a separate structure. So if you're a sole proprietor, before you make that LLC election, And then if you start out with an LLC, sole proprietorship, or a partnership, which is two or more people in the partnership, you are taxed the same. It's income minus expenditures. Now, there is one availability to be a subchapter S corporation, and you can convert your LLC to a subchapter S. So you can either start out right away as a subchapter S, or you can first get that LLC and say, well, I'm going to kind of see. I'm going to see where business takes me. I'm going to see if I end up having a partner. So an LLC structure is so flexible. That's why we recommend it. And then later you could simply make a subchapter S election. Now, I don't want to lighten a subchapter S because if you make that election, you must put yourself on payroll if you're one of the owner operators. So now you have the cost of administering payroll, and you have to keep your books and records such that you could produce both a balance sheet and a profit and loss on the return. And then you also have to file a separate tax return. That could add $3,000 to $5,000 in professional fees to administer payroll. You can do it through programs like Intuit, or you can hire, the companies like Paychex, ADP, Paylocity, those kind of, big companies. But there's some additional costs. But there's some tax savings potentially. So if you can make the argument that I have a team and my team helps me produce this income, I put myself on a fair and reasonable salary, and then I take the rest out in distributions, and that is Social Security and Medicare tax free. So you could possibly save that 15.3%. But I would say have a conversation with the professional before you decide doing it so you know exactly what you're getting into, because I've seen a lot of people make that election and they're not prepared. And then they have expensive penalties because they just haven't done, things correctly from the start. Then after you decide what entity you want to be, of course, you're going to obtain your necessary licensure. If you do end up operating in multiple states, you do have to make sure your LLC is qualified to do business in multiple states. Do you want payroll? If you want payroll, you have to make sure that you are complying with the rules of payroll. Workman's comp is mandatory. There's two new programs in the state of Delaware. One's called Delaware Earns, and that's if you employ 5 or more individuals and you do not have a retirement plan, you must participate in the Delaware Earns, which is basically a Roth program, Roth IRA program for your employees. And then there's Delaware Family Medical Leave, and that's for 10 employees. Will cover the maternity and paternity too, and then 25 will cover the medical portion of it. So there's a lot on employers. So before you make that jump, really educate yourself, because I see this as an area too where people underestimate it and then end up kind of getting themselves in trouble later. You want to make sure you get your adequate liability insurance. And then, real important, establish your method of bookkeeping and who's going to be responsible. So there are some great programs out there that are really using AI. QuickBooks is one of them. That's an Intuit product. It's cloud-based now, and it's pretty user friendly once you get someone to kind of help you set up. Because the idea with it is that you sync your bank accounts and your credit card accounts, so those transactions come in automatically. But to make it successful, you need to set up rules, and those rules tell the program, if I pay Delaware Association of Realtors every year, that's a dues and subscription. And so then the program will automatically, once you've set up that rule, every time it sees that vendor, then it'll go ahead and record it as that. So if you invest the resources and the time to get it set up correctly, it can really save you in the long run. All right, so keep clean and thorough records. I try to tell people, I understand you a lot of times are like in your car constantly, you're just coming and going just in time for meetings, and you're like, how do I, it's the weekend finally, and I want to have fun, and I'm still showing properties, and the last thing I want to do is 5 hours of record keeping. And unfortunately, that's the priority usually. You're excited about running your business, you want to make money, you want to develop, you want to grow. And so a lot of times the record keeping gets pushed off. And then what happens is then you're like, oh my gosh, I haven't made any estimates because I don't even know what I've made. and I don't even have my receipts or anything. So just come up with a method and a system. There's so much now in technology where you can scan in receipts and have them cataloged. Just to also remind you, though, that a credit card statement is not sufficient documentation. And I always give the example of I can go to Sam's Club and I have a $500 purchase, but it doesn't say on there that I bought office supplies. So if I buy, at my bottom end line of the Sam's receipt is $500, then on the credit card it just shows 500, but it's your actual receipt that shows everything that you purchased and what qualifies. And be careful not to take the highlighter to those receipts because the ink will disappear. And the burden of proof is on you. It is actually on you. The only time it's on the IRS is if they suspect fraud, then it's their responsibility to prove. But otherwise, the burden of proof is on you. And if you don't have the proof, the IRS can disallow deductions, which if we go back to that 41% example, they disallowed $10,000 worth of deductions. You're now paying an extra $4,000 in tax, and you're going to have costly penalties and interest because the statute of limitations is 3 years. And so the IRS, and trust me, they're not efficient about coming after people. 3 years later, that 4,100 is easily, $6,000. And so now it becomes quite a burden. So keep your clean and thorough records. Even if they're receipts, just make sure you're putting them consistently in one place. Are you using a program like QuickBooks, or are you going to use like software, like a spreadsheet, an Excel spreadsheet to load them? But have some kind of method for keeping your records. Now, saying that, we're going to go into later, like things like meals, auto, how do you keep record of that? So we will go into those details. And you really want to make sure you keep those records pretty close to the time that you made the expenditure, because I don't know about you, I could barely remember what I had for lunch yesterday. I can't imagine when it's tax time, I'm supposed to try to remember what happened last February. That's very hard to sometimes recall. All right, let's talk about vehicle. This is always a pretty big question. If you are in business and you use your vehicle for business, it is deductible. But, so a lot of what I'm going to say today is going to have ands, ifs, and buts. So there's a basic rule, and it's based on usage of your vehicle. And one thing I want to put out there right away, you can put on there a wrap, you can put your business name, all that on there. That doesn't automatically make that vehicle 100%. Doesn't mean it's automatically a billboard. It's 100%. The IRS lets you deduct the cost of the graphics or the wrap, but that doesn't mean that vehicle is used for business. So I could have it on my car, but I may never drive anywhere for business. Let's say I work 100% from home, but I've got my logo on my car. It doesn't make my car deductible. Business usage is what dictates if your car is deductible. Now, if you take a look at your mileage for the year and you say, well, I put 20,000 miles a year on my car, and I drove my car 12,000 miles for business, that's over 50%. And the IRS lets you choose, do you want to write off the vehicle? And that's called depreciation. Do I want to write off, that would include the fuel, the insurance, the repairs, the maintenance, and everything, but according to that percentage. So again, if my business use is 55%, then I could depreciate the car 55%, 55% of fuel, 55% of insurance, 55% of repairs and maintenance. Or you could do what's called the mileage method. The mileage changes every year. Like last year, it was 67 cents. I think it's even higher this year. That's a pretty big deduction. So if you drive your car 10,000 miles a year, you're going to get almost a $7,000 deduction. Now, you can't flip-flop between the methods. You can't say, oh, well, I'm going to write it off because it's the first year I bought it. I bought that over 6,000 pound SUV. I'm going to get that big deduction. I bought that truck that's heavy duty. I'm going to write it all off. And then the next year, because I've written it all off, I'm going to switch to mileage. The IRS isn't going to allow you to flop methods. So it's very important to make the decision while, maybe when you get a new car. Now, there are some exceptions that if you're on the mileage version, then you can convert. Now, if you take the mileage, that replaces depreciating the car, a percentage of the insurance, the fuel, repairs and maintenance, that replaces it. So in one way, that's pretty easy, right? I'm just going to take my mileage. But if you're like me, when I get in my car, I'm getting in my car just enough time to go where I need to go. I don't have time to get out a log or reset an app or whatever. So the IRS says as long as your record exists by the time you prepare your tax return, you don't have to have the record done throughout the year. I don't have my record done throughout the year. So what I do instead is I keep an extremely detailed schedule, calendar, and then I convert that to a mileage log. There's also other apps like Mileage IQ I've seen used. TaxBot is another app. Some of those apps will allow you to scan in receipts. So if you want to drop in the chat, if any of you have success with any business auto use technology or just general business use, drop it in that chat and we'll just kind of read off a few that some of you are using. All right, is there any questions on that at all? It can be, on one hand, it can be confusing because of the 50% rule. If you do depreciate, it's heavy duty, it's 6,000, pounds or greater, you can write off more than if it's considered luxury, you're writing off less. So that, again, there's a lot of ands, ifs, or buts with auto. Okay. We'll go back to that if we, oh, somebody says they use QuickBooks to track mileage. And that's great because if you're already using that platform anyways, and you're paying for that platform, you might as well maximize it too. Yeah. Okay, home office deduction. This has changed over the last probably 15 years. We used to have this arduous process, and it was kind of known that if you claimed home office, you were going to be audited. And there was a lot of audits around home office because think about it, you're writing off a portion of your home, it's based on square footage. I've had an audit before of counseling service that she used her basement, and the IRS challenged it and said, well, you only use that occasionally. So your space has to be used regularly and exclusively. That's tough nowadays with a lot of us doing work on laptops. And we might say, well, I'm on the kitchen table constantly, or I'm in my dining room. That is really not an office. So an office, again, is supposed to not be shared space with other, space in your home. It's supposed to be regularly and exclusively. So one thing we've been doing probably over the last 12 years is just encouraging clients to take the simplified method, which is $5 a square foot limited to 1,500. Because, and let me tell you why, because you can say, well, if I go the long method, I'm going to get a better deduction. You might, but this is the number one mistake with someone taking the long method. When you do that, you also have to depreciate your home if you own your home. Now, if you're renting, you can write up a percentage of the rent, utilities, all of that. So it may be better if you're a renter, it may be better to do the long method because there's nothing you have to recapture later. So let me just put that in a quick example. I bought my home for 100,000. Over all these years, I've written off 10% for office in the home because I determined that I use 10% of my home, or an office in my home. And so I depreciated over years, 10 grand. And then I go to sell my house. And as many of you know, as long as you lived in your home 2 out of the last 5 years, you get a $250,000 exclusion per owner. So if you own that with someone else, then it could be 500,000. You don't pay taxes on anything unless you depreciated prior office in the home. Now you're paying taxes on that 10 grand that I gave in that example because you took the long method. And then I get asked all the time, well, let's do the long method, just don't depreciate. The code does not allow for that. It's called deemed depreciation. So even if you didn't take it for all those years and you go to sell it, you have to recover what you should have taken. So again, unless you're renting, It may just be less complex, and especially if you're not crazy about paying income on depreciation recapture, then I would recommend doing the simplified, method. Unreported income can really get people in trouble. And I'll give you an example of how it can affect you in your industry. I have seen this where a real estate agent has gotten two different 1099s, one for commission and one maybe for property management. And they didn't realize it and thought, well, if I get one check or I get one, I only work for one broker, then it probably was all on that 1099. And then they didn't realize. And then what happened was that the IRS has a way to see that's called transcripts, everything they've received that's been reported and what you reported, and they do a reconciliation. So now that's an example of you report 150 of income, but you really had 200,000 of income, and it could trigger an audit, which you really don't want to trigger an audit. Another thing I have seen happen too is that you might get a commission on the last day of the year. That is considered to be paid, and as long as the check was presented to you, you waiting until January 5th to put it in doesn't make it January 5th income. And your broker's issuing the 1099 and they're including that December 31st because they wrote the check on December 31st, or they did the ACH or wire to you on December 31st. So I've seen this happen where the client's given me their books and records, said they made X, and then all of a sudden that 1099 didn't agree. They couldn't find it, didn't supply it to me or whatever, and I didn't know. So that's why it's so important to make sure you're doing a matching of what you think your income is compared to the 1099 that you're getting. So it will definitely trigger a notice, and it could be subject to penalties and interest. And unfortunately, they usually don't catch that right away. So it could be years later from filing that they catch it. And unfortunately, you are obligated to pay the penalties and interest unless you had reasonable cause to ask for abatement. So you want to be careful with those two instances actually I gave you. All right, another hot topic is the whole entertainment, travel, and meals, because they're treated completely differently now due to the Tax Jobs and Creation Act of 2018. That changed things. So right now, currently, you can only deduct 50% of your business-related meals. So again, keep that phrase in mind, business-related meals. All entertainment expenses are non-deductible. It doesn't even matter if it directly relates to you conducting business. Like let's say you go to a sporting event and you go to the sporting event with a contractor that you just started listing homes with, and you say, well, this is really business. Unfortunately, the sporting event ticket is not deductible. Now, the food that you had while you were there is 50% deductible because there was a business purpose to it. You were with the contractor that you do business with. So that's an example of that. But now golf, outings aren't. But I have to say what the difference is let's say I'm playing in a charity tournament and there's a per price, fee, or I advertised in one and I got to play in it. That's a little bit different. You could call that promotions or, advertising. Now let's talk a little bit about how can I make a meal not 50%? If there is a presentation associated with the meal, or you do a broker's open. So you do a broker's open and you have, you catered it, a couple $100 worth of food, some beverages. That's 100% because that was an event. That was a meeting expense. Let's say you have a meeting in your office and you guys rotate and, different people bring lunch, whatever monthly. That is actually a meeting expense. Let's say you do go out with that contractor we were talking about that you want to exclusively list their, their neighborhood that they're building. That's a meeting expense because there's usually like a presentation part of it, or, something like that. So that's how you can get that to be 100%. But if you just say to a fellow realtor in the office, say, hey, you want to go grab some lunch? I want to run an idea past you. That's business related, but it's 50% deductible. Now, the meals are the only exception to keeping a receipt. The IRS lets you document meals up to $75 without support of a receipt. So every Wednesday morning, I meet a group, I have some coffee, a Danish, spent $15 with gratuity. I just make note of that. $15, such and such breakfast, business related. Then you don't have to keep the receipt. So some people like that. Some people feel like the receipt is what reminds them to take the deduction because they write on top of it what the nature of the, meeting was. So now let's talk about membership dues and fees. Again, if there's a business purpose to it, this would be your membership to KCAR, Delaware Association of Realtors, Central Delaware Chamber of Commerce, any kind of trade organization that has a business purpose, you can 100% deduct. But you can no longer deduct fees paid to country clubs or social organizations. They aren't qualified organizations. So unfortunately, you can't even deduct those. So if you belong to Wild Quail and you say, well, I'm going to write that off because I take people there all the time for dinner, the dinner's deductible, but not your membership. You can say, well, I take people golfing. Remember, golfing's not deductible. It's the meal, that you have. So it's unfortunate. My whole career, entertainment was 50% deductible. 2018, shut it down. Big tax increase for some people. But like everything else, I'm sure the rule came about because several people were abusing it. And that's what happened. So unfortunately, the rest of us suffer because a few, abused it. All right, travel. Let's talk about that. So if you're required to leave what we call like your tax home, so your work requires you to. So let's do an example of you are a realtor in Newcastle or Sussex County, but you'd like to go to the annual DAR convention at Bally's. Well, you're like, it's late. I'm taking CE, sometimes late. They have like a closing party. I might not be done until 9. Then I stay back with some realtors and we talk, and now it's 10. I think I'm going to get a hotel. That is considered reasonable, and you can write off 100% of the hotel. You can write off your mileage to get to Bally's, or if you're depreciating your car, you have the fuel and all of that. Tolls and parking are outside of the mileage. So tolls, parking, and interest you may pay on your car is deductible, even if you take the mileage method. So you're away from home. The rules say rest is needed to meet your demands of work. You must leave your tax home. Again, you could argue that, well, my market is pretty much here. This is where I pretty much travel. I go from Clayton to, Wilmington. So to go down into an entire different county is considered away from my tax home. So I tell people too, really think outside of the box with this. So is there a convention or something you want to attend and it's in Vegas, it's in Orlando, and it's business related? Go attend it, and chances are most of that trip or all of it or maybe some of it will be deductible. Well, let's give it an example of what could be the different levels of deductibility. So if I go for a 7-day trip to Orlando, but I only attended a conference for 2 days, that wasn't a majority of the time. I can only deduct 2/7 of the trip. But if I went for, let's say 5 days and the conference was 3, that's a majority of the time. So now you can write off 100% of your hotel, airline, if you did drive, mileage, rent a car, Ubers, gratuity, all of that. And then the food while you're there is 50% deductible. So that food is still 50% deductible. But unfortunately, you go to Vegas and you're like, oh, I want to see a Cirque du Soleil show. That's entertainment. That's not deductible, even though you might have went with the participants of the conference, it's still not deductible. Let's say there's a conference on how to go paperless with your practice and you attend that. Again, it could be business as long as there's a business purpose to it, a legitimate business purpose to it. So I tell people, try to work in a destination that you want to go to, try to work it into your travel. All right, so again, you have to have adequate records. That is the taxpayer's responsibility, period. And it has to have the amount of the expense, the date, because of course, what tax year are you doing it? The nature of the travel or the business meal to establish the business purpose of that expense. This is just something we kind of came up with, but it's paper, it's not digital, for people to think about, well, what could be deductible as a realtor? What am I maybe missing? Well, first and foremost, I tell everyone, ask yourself the question, is this for business purpose? Am I doing this, spending this for business purpose? So, if the answer to that question is yes. So let's say you work from home primarily, but you drove into the broker's office today so that you could watch this seminar together. That is a business purpose, so the mileage coming in is deductible. Let's say you were like, hey guys, I'll pick up the breakfast on the way. Breakfast is, deductible because again, you had a business purpose. So these we can supply to you electronically if you do want them just to make sure. But it's basically anything that you spend money on. But really those out of the box things are travel, meals, and mileage. That's really kind of the out of the box. But you buy a computer, you might buy a separate camera, you might have a drone, a tablet, your cell phone. All of that technology, if it's used for business, is deductible. I have to laugh on here. It says faxes, and I don't even know if people do faxes much anymore. But ignore that. I don't think I've sent a fax in years. So yes, somebody was asking if they can get a copy of that. If we can't put a link in the chat, we'll make sure then that Matt gets it so that he could distribute it. Okay, I'll leave that to Denise and Matt. All right, the next slide is just an example of how QuickBooks could look for you. So again, QuickBooks has moved from the desktop version to the online version. And depending on the version you get, it could be as little as around, I think it's around $30, $40. If you are already partnered with a firm, like for example, Faw Casson's partnered with Intuit, we don't accept any money or kickbacks from them because we want to be independent. But we extend our 30% wholesale discount on the platform. So this is really a simple P&L, how it would look. If you want, you can book your buyer and your listing sales separate. So if you want to know where that's coming from, if you do have rental income, you could separate that. And then if your cost of sales might be your direct costs relating to earning that income. So did you have to split the commission? Did you pay for an inspection? Did you pay for a repair? That's a direct cost of earning that income. So here's your gross profit. And then the rest is general and administrative expenses. And again, I would keep it simple because some people tend to, like advertising, for example, they might say, list all of them. Facebook, SOI content, and then before you know it, you've got 10 advertisings. Well, you can consolidate if you want. Like here's brief 3. You can consolidate and keep it all in advertising and promotion. And then you can run a report that shows you by memo what specifically you were using. I always recommend business owners to really understand their advertising because you could be getting leads, but are they leads that you're closing? How many of us have prescribed to something and gotten just tons of leads and you have just wasted time calling, and maybe had a 1% conversion rate? That might not be the greatest advertising, even though maybe you got 100 hits. Was it worth one? And all that time you spent, you probably spent more time than the commission on that one. So really track not only your advertising, but track your close to see what's producing results. And then the rest of these, again, are just basic categories. Like office supplies could also have postage in it. You don't have to put postage separate. I always tell clients an expense is an expense. Postage and office supplies are written off the same way. So if you print business cards or you have anything printed, promotional products, that could go up in advertising. But let's say you accidentally put it in office supplies. That's okay. It's still deductible. It's more just for you, for tracking purposes. You want to see consistently maybe what you spent on advertising. So if you're not consistent with your recording, then your financials might not give you the results, that you hope for. Other ones, of course, are oh, thank you. Denise just put that in the chat. Thank you so much, Denise. Travel, and you can see it was broken down between hotel, meals, and transportation. Meals, you do want to have separate because they are 50% deductible. The IRS also, or Congress really simplified things a while ago on when you buy equipment. If it's under $2,500, you could just call it a supply. If it's over $2,500, then the depreciation rules apply. So if you buy a cell phone for $1,500 and use it 100% for business, you don't have to allocate it business and personal, then you just write it off as a supply. Computer maybe for $2,400, write it off as a supply. Camera, you get the point. All right, I want to talk briefly about a Section 1031. This is called a like-kind exchange. And this is unique because the like-kind exchange rules have changed. It is really only for real estate. We used to be able to do it for like-kind property. Like, for example, if a business owner bought a car and then they traded in on another car and they fully depreciated it, that means that trade value would be 100% taxable as a gain. Well, the old like-kind rules said, nope, you could just roll that into the basis of the new car. They eliminated that. Section 1031 is only for real estate. And please don't give the advice that is for personal residence. It is not for personal residence. Those rules are completely different. This is for investment. So it can be land for land, building, rental. Like I could take 8 townhomes, sell them, defer the gain, and buy one beach rental home. I could do that. Or the opposite, I could buy 8 for the one I sold. So again, this is investment property. And this basically goes into what you can't do it for: stocks, bonds, securities, interest in a partnership. So you might have this property in a partnership and you say, well, I'm going to do a like-kind exchange. You can't, but there's a way to work around it. You could simultaneously take the property out of the partnership and then sell it, and then go ahead and do your like-kind exchange. So there are very specific rules with a 1031. You have to have the entire transaction completed in 180 days. So you have a very tight window, and you have to identify your replacement property in 45 days. So I say, I'm going to sell those 8 townhomes. I can't just wait 6 months to identify my one beach home rental that I want to buy. I've got to identify it in 45 days, which means there's a contract on it or a letter of intent or something. And then I got to close within 6 months. And those rules are extremely strict. You can ask for, for an extension, but I can tell you the IRS now with its limited capacity, they're not responding timely. It could be years, and then you have to know. You have to know how to report this on your return. So I just wanted to give you, a little bit of, it was a high level, but some information on 1031s. So right now, bonus has just recently changed because of the one big beautiful bill. So this is a correction to the slide that I'm telling you. It's been restored to 100%. And what that means is if I did buy something over $2,500, I can write off 100% of it. So that's simply what bonus means. And it was brought in, all we used to have was Section 179, same premise. I bought it, I could write it off 100%, but 179 has limits. It has a cap. Bonus doesn't have a cap. That's why we were excited when bonus came back from very large clients who are investing more than $1 million in equipment. they can now take bonus and they're not limited by Section 179. So they kind of work almost the same, but 179 has caps, bonus doesn't have caps. So again, you might want to consider, well, what do I want to do? Do I want to write it all off now? Because do you want to yo-yo your income? So you say, well, I had a really good year. I'm going to buy that Tahoe that's over 6,000 gross vehicle weight. I'm going to put it in service December 31st. So I'm going to write all of it off. But the next year, your year's just as good, and now you have no write-offs. So you really have to, I personally think, avoid yo-yoing because you might actually cost yourself more in taxes. The goal is to equalize your tax rate, not have it spike up and then down and spike up and down because your average is probably going to be more than if you just equalize it as much as possible. All right, so let's talk about the one big beautiful bill and the impact on businesses. So I'm just going to give you some highlights. We've got about 15 minutes left, and I do want to allow for some, again, please ask any questions now, but I will allow for probably 5-8 minutes for some questions. So couple things that got locked in. There's this thing called a qualified business income deduction, QBI. And what this basically was is that if some of you remember C corporations, and that's a corporation that pays its own tax. And if you take the money out of it because you're the owner, you're double taxed on it. So it's not a very favorable tax structure. There's a time and a place for it. But for people who want to take their money out of their company, it doesn't make any sense. So Congress gave C Corps a flat tax of 21%. But then owners of LLCs, sole proprietors, partnerships, S Corps were saying, that's not fair. They get a 21%. Well, I want to now be a C Corp. Well, we got to ask, oh my gosh, hundreds of clients saying, that's it, I'm converting. And we're like, well, there's still some drawbacks, to it. So Congress then said, all right, we'll give the rest of you a 20% deduction on pass-through businesses. And that's your sole proprietors, LLCs, S Corps. And your rental activity can also qualify for the 20% deduction. So that's nice. 100% bonus I talked about. The 179, I told you there was a cap. There it is right there. Research and development, this probably isn't applicable to this audience, but they do have some favorable deductions in the current year that you spend money on research and development. And basically that's for redeveloping an entire process within your organization, and it costs money for you to do that. Won't go into the losses and interest deductions. That's again not doesn't occur, all the time. So one thing they did is they simplified the 1099K platform. I don't know if a lot of you remember hearing, but if you even got paid on Venmo, you were going to get a 1099. And I don't know about you, but like some of us were panicking going, oh my gosh, there's money constantly going back and forth between friends and fundraisers and all kinds of things. I might get $600 because somebody's reimbursing me or a gift they gave me or whatever. Now you're telling me I'm going to get a 1099. How am I going to report that on my return to show it non-taxable? So luckily they changed the requirement for the reporting to be $20,000 or 200 transactions. So that makes a lot more sense. Your business too is required to give anyone that you pay for a service $600 or more. So you pay a photographer to take pictures of a listing and you paid them over the year, not just one instance, over the year, $5,000, you are required to 1099 them. That's called an NEC, non-employee compensation. If you do not do that by January 31st, there could be significant fines, and those penalties you cannot get abated. They're called a civil penalty, and the IRS will not abate them. A miscellaneous is rent. So if you own, if you're a landlord, and you have, well, for example, let me give you an example. It's more of your industry. You have brokers, and they have tons of landlords. You need to send 1099s out for the rents that you collected. Or if you have a property management division, then you are required to send out 1099 miscellaneous starting next year. And when I say next year, I mean next tax year. So unfortunately, the $600 limit is in 2025. Starting in 2026, it's $2,000, which is nice. Finally, it was $600 back when I entered this profession 36 years ago. So it's about time that they indexed it. Another one popped up. Oh, I lost it.
It says, how do you do a 1099 to a photographer or such?
Yeah, so a photographer would get a 1099 NEC, non-employee compensation. You would get a W-9 from them, which gives you their name, address, social or EIN, and then you have to fill out the 1099 NEC form and give it to them by January 31st. There's now an e-file requirement. If you have more than 10 1099s or W-2s in a year, you must e-file these forms. If you do have the QuickBooks Online platform, QuickBooks Online can do these forms for you. All right, won't go into the investment zones or qualified small business. I'm just trying to go over things that are, relative to, the audience. Let's talk just really quick on the impact to individuals. So there were 7 brackets that came about with the Tax Jobs and Creation Act. Those are now permanent, so it made it where were some less tax, and it took the max rate from 39% down to 37. The standard deduction now is much larger. It's $31,000 for married, filing, joint. And if you don't hit that itemized level, which means my property taxes, my charitable contributions, my mortgage interest, if it doesn't exceed 31.5, then you take the standard deduction of 31.5 instead of itemizing. There's a huge on tips, and this was really misunderstood. It was like, oh, I don't pay any tax on tips. Nope, not quite. So unfortunately, it's only on up to the 25,000 a year in eligible tips. So when you go to a restaurant and you pay 18% because you're a greater party than 6, that is a mandatory tip, and that's not part of this $25,000. There's also very, very low adjusted gross income thresholds. So we're probably really not going to see a lot of people be able to take advantage of this. Same with overtime. Overtime is up to 12.5 for single filers, 25 for joint, but there's limits. Car loan interest. This was deductible way back in the 90s when I was first in this industry, and then they took it away and now they brought it back, but it's capped at 10,000 and it's subject to new US assembled vehicles. So it's very restrictive. Senior deduction. This was misunderstood too. I even had my own uncle call me and say, so I don't have to pay tax on my Social Security? No, uncle. So unfortunately, there's a cap, unfortunately. It's 75,000. So if you're single and you make over 75,000, or married filing joint and make over 150, you will not qualify for the $6,000 deduction if you're 65 or older. So you may be a realtor that's 65 and older and still working, and you're like, well, I make over that amount, I'm not going to get that $6,000. Child tax credit was raised from 2,000 to 2,200 permanently, indexed for inflation. And now you no longer have to itemize to be able to take a charitable deduction. So if you don't itemize, you could take a charitable deduction, 1,000 if you're single, $2,000 for joint filers. And adoption, there's an adoption credit. There always was an adoption credit, but it was non-refundable, which means I don't have tax, I don't get the credit. Now it's refundable even if you don't have tax. So this is huge. There's some retirement and savings incentives. There's some Trump accounts, and those have their own, rules as far as that goes. Health and dependent care enhancements. So HSA has been raised, dependent care, FSA, employer student loan assistance. So if you're an employer and you have employees, you can actually give your employees up to $5,250 tax-free towards their student loan. I just had a client do this. But they had to pay the institution direct. They couldn't pay the individual, but they paid the institution direct. And the employee got a tax-free benefit. So that was really nice. A lot of clean energy credits were cut. Clean energy, also energy improvements in your home. That was the exterior doors, windows, insulation, attic fans, tankless water heaters, all of those, if you had a high SEER rating HVAC system, they've eliminated those. And again, if there's tax decreases, they got to raise taxes somehow, right? And this is one of those areas that they raised them. Okay, that was a lot. As you can tell, I talk really fast. So hopefully You absorbed it, and I have to thank Denise. I think I saw where you actually put in the W-9 form. So if you do have like that photographer, whatever example I have, get that W-9 complete. You're actually supposed to get that W-9 completed before you even pay them. It's your responsibility to have their information. And she put in there the one big beautiful bill information too. All right, are there any questions at all? Comments, anything? Okay, well, I have to give a plug if anybody's still coming up with their question. We do have a podcast, Accounting and Accountability, and it is out every other Friday. So I think our next installment will actually be is it next Friday, Denise? With a shake of a head, next Friday. Yeah. So November 14th, I believe it is. We'll have a next installment. We start our podcast with tax tips. And sometimes they're really valuable tax tips. And then we have entrepreneurs as guests. So if any of you are on this and you say, I want to be your guest, and it's super easy. It's not even scary. Please let us know. Denise can set you up. She's the one that coordinates our podcast. We'd love to have you on as a guest. Again, we highlight entrepreneurs in and around our three counties because we have offices in Dover, Rehoboth Beach, and Ocean City. So good podcast. And then there's my information on that slide. So if you do want to email me after this, you have a quick question, please let me know.